Forget the Silicon Valley hype cycle. The most important merger of the decade didn't happen in a garage, but in a fermentation tank. Welcome to Novonesis. We're moving from a world built on breaking things with heat and oil to growing things with precision biology. This isn't just an annual report summary. It's an autopsy of the fossil chemical era and a blueprint for a bio-based alpha. At HDIN Research, we don't follow trends. We track structural shifts. Let's look under the hood of the invisible giant, powering your breakfast and your planet. While the traditional specialty chemical market looked like a crime scene in 2025, down 25% in market cap, Novonesis pulled off a 7% organic sprint. How? Because biology isn't just a green alternative, it's a structural upgrade. Think of it this way. Traditional chemistry is a sledgehammer. Enzymes are surgical lasers. When you can replace a carbon-heavy refinery process with a room-temperature microbial fermenter, you aren't just saving the planet, you're fixing your P&L. If fossil chemicals are legacy hardware, Novonesis is the new operating system. Let's get McKinsey serious for a second with some SCQA logic. Situation: global manufacturing is addicted to carbon. Complication: carbon is now a liability, regulatory, social, and financial. Question: can we maintain 50% food margins without the fossil footprint? Answer: the Novozymes/CHR Hansen merger. This isn't just a corporate marriage. It's a mise, mutually exclusive, collectively exhaustive, monopoly on the microbial world. We're talking about a combined strain library that makes the competition look like they're playing with Legos, while Novonesis is building the matrix. Novonesis isn't just hoping for growth. They've engineered a 3-pillar roadmap called GROW. First, they grow the core, essentially squeezing 9% growth out of emerging markets where others see stagnation. Second, they enhance position by using their 150,000 microbial strains to create switching costs so high, customers couldn't leave even if they wanted to. Finally, the venture model, betting on enzymatic plastic recycling. It's like a venture capital fund buried inside a stable blue-chip chemical giant. Boring stability meets moonshot upside. Numbers don't lie, but they often whisper. While end-market volume grew a pathetic 1.5%, Novonesis clocked 7% organic growth. That 5.5% delta is what we call structural alpha. It means they aren't just riding the tide, they are the engine. They are capturing value from incumbents by solving problems fossil fuels can't touch. In a flat world, 7% growth is basically a miracle. It's like Novonesis is running a marathon at a 4-minute mile pace while everyone else is still putting on their shoes. What happens when you combine 150,000 biological strains with AlphaFold and hybrid quantum computing? You get a 300% yield improvement. In the old days, R&D was spray and pray. Today, Novonesis uses AI to predict 3D protein structures before they even enter the lab. They've essentially turned biological discovery into a software problem. If you think NVIDIA is the only way to play the AI revolution, you're missing the wetware play. This is AI actually doing something useful, like engineering bacteria to eat carbon for breakfast. Total addressable market, $1.13 trillion. That's enough money to buy every person in New York a Tesla. Novonesis is currently just a fraction of that, which tells you the runway here is longer than a transatlantic flight. By pivoting into specialty chemicals, they aren't just selling enzymes, they're selling decarbonization as a service. Combine that with a 39% EBITDA margin target by 2030, and you're looking at a cash flow machine that would make a private equity partner weep with joy. Let's talk cold hard cash. $4.7 billion in sales, with an 8% jump in EBITDA. But the real flex? They reinvest 11% of sales back into R&D. Most chemical companies treat R&D as an expense to be cut. Novonesis treats it as the fuel for their moat. When you spend $500 million a year on science, you aren't just a manufacturer, you're an IP factory. Their free cash flow is 19% of sales. That's software-level profitability from a company that deals with physical microbes. Merger integrations usually go about as well as a Tinder date in a hurricane. But Novonesis is 12 months ahead of schedule. They've already matured their cost synergies. Why does this matter? Because it proves management can actually execute, not just make pretty slides. Revenue synergies are already adding 1% to organic growth. They aren't just saving money by firing redundant middle managers. They're actually selling more yogurt and enzymes to the same customers. That's the holy grail of M&A. You probably use Novonesis 5 times before lunch. They have a 50% market share in industrial bread and yogurt. 2 billion people, that's 1 in every 4 humans, consume their technology daily. They are the Intel inside of the food industry. You don't see the brand, but without their enzymes, your bread is stale and your cheese is sad. This level of market penetration is essentially a biological tax on the global food supply. It's the ultimate toll bridge business model. How do you stay on top? You build a moat out of 10,000 patents and 150,000 strains. Their vitality index is at 25%, meaning a quarter of their revenue comes from products that didn't exist a few years ago. In the world of biology, if you aren't evolving, you're lunch. Novonesis is the apex predator because they innovate faster than the incumbents can copy. Every new patent is another brick in a wall that's getting very, very hard to climb. In 2025, Novonesis dropped $1.79 billion to buy out their partner in the Feed Enzyme alliance. This was a margin grab, pure and simple. By owning the whole chain, from the lab to the farm, they stop sharing the steak and keep the whole cow. It's expected to add 25 basis points to the 2026 margin. It's a classic McKinsey vertical play. Eliminate the middleman, control the pricing, and capture the full value of the biorevolution in animal health. Most companies brag about lowering their footprint. Novonesis brags about their handprint. Their solution saved 80 million tons of CO2 in 2025. That's 60 times more than they emitted themselves. If you want to play the ESG game without the greenwashing, this is it. They aren't just less bad. They are actively good. When your customers save money by using your carbon-saving tech, sustainability stops being a cost center and starts being a competitive advantage. Talk is cheap. SBTi validation is expensive. Novonesis has a roadmap to net zero by 2050, and they've already hit 100% renewable electricity. They're targeting a 75% reduction in Scope 1 and 2 by 2030. This isn't just corporate virtue signaling. It's risk management. As carbon taxes inevitably go up, Novonesis's cost base stays flat or goes down. They are essentially shorting carbon while everyone else is long. They aren't just cleaning up their own house, they're cleaning up their neighbors. The PAV to Zero program forces 200+ suppliers to align with science-based targets. They're even switching from air to sea freight. Why? Because Scope 3 is where the real carbon bodies are buried. By cleaning up their supply chain, they make their end products even more attractive to Fortune 500 customers desperate to hit their own climate goals. It's supply chain management as a sales strategy. No business is an island. Novonesis faces real risks, cybersecurity threats to their biological data, biohacking isn't just for movies, and the EU's habit of over-regulating anything that sounds like science. Then there's the geopolitical mess, trade volatility impacting the flow of microbes. But their global manufacturing footprint acts as a natural hedge. They aren't just in the market, they are of the market, producing locally to mitigate global chaos. Capital allocation is where strategy meets reality. Novonesis is pouring 12 to 14% of revenue back into CapEx. They aren't just maintaining old factories, they're building the biofoundries of the future. With a leverage target of just 1.5x, they have a, quote, fortress balance sheet. They can afford to be greedy when others are fearful. This is the financial discipline that allows for biological dominance. Look at 2026. Management is guiding for 5 to 7% organic growth. Yes, exiting Russia and Belarus hurts the top line, but the 1% synergy boost and value-based pricing are the secret sauce. While others are fighting over pennies in the price war, Novonesis is raising margins by delivering superior tech. They are targeting a 37 to 38% EBITDA margin. In the chemical world, that's basically God mode. The core is food and health, but the horizon is everything else. Enzymatic, plastic recycling, carbon capture, future fuels. These aren't just buzzwords. They are the next billion-dollar divisions. Novonesis is essentially a platform company, like Amazon Web Services, but for biology. Once the platform is built, you can run almost any industrial application on it. The future isn't just green, it's enzymatic. That's the deep dive. Novonesis is the proof that you can have high-level margins with NGO-level impact. If you want the full-page PDF of this analysis or need a bespoke research report for your investment committee, you know where to find us. Drop a comment below. Are you long on Biosolutions, or are you still betting on oil? Hit subscribe, follow us at HDIN 230, and remember, in the 21st century, the most powerful code isn't binary, it's DNA.